Hey folks, T-Buzz here. I always like to cover the risk involved in trading. And the bottom line is you control the risk and you have to measure that risk. And there's not one successful trader out there that doesn't manage their risk. There's high degree of risk involved in trading. Anybody tells you different, they're wrong. I've been doing this a long time, and I got to tell you, that's the most important thing you got to worry about when you do trade. And I always like to say past performance is not indicative of future results. Now, my YouTube channel, it's quite new, but it's growing and it's free. So if you listen to this video and you want to be a member, you go to youtube.com/@TBuzzTNT. And I just found out if you're a member there and we ring that bell, it will notify if I'm going live anytime. So that's pretty neat little feature. So be sure to make sure that when you do sign in, you subscribe to the bell ringing, because I'll ring that bell for you, every now and then. You will be live. That's with the youtube.com/@TBuzzTNT. Now, customer service live. We've got this put in place to make sure that during the week, if you have any question that involves trading, or you're thinking about, you heard something you want to see that we talk about, you go to our live Zoom meeting where you can sign in and ask your questions. These are very knowledgeable people in there. Go to dtitrader.com/help. That way you've got it set up and you can get your questions answered without you wasting your time trying to dig out your notes that you probably can't read anyway. Now, options made simple from a 40-year option trading trader. Folks, I go back to the very first time I traded my first option, and I think about, what if I knew today what I knew then? Obviously you can't, because there's just so much to learn. There's strategies. There's certain rules that you will develop, certain guidelines that you might pick up from other traders that will help your trading. And then at the end of the day, no option is going to be perfect. You're going to have to learn how to turn that lemon trade into lemonade. That is what I would call the three main things that I want you to focus on, especially if you're just getting started. Now, what you're looking at is when I was first introduced to options. Back in the day, there was a service out there called Value Line Options. They're still around today, but anyway, they had this chart here because people start talking about buying a call or selling a put. I'd get so confused, but it's pretty simple when you break it down this way. For example, we buy a stock. How do you make money? It goes up. Calls work the same way. If you buy a call, and the stock goes up, you putting yourself in a position to make money. The same thing with call spreads. Don't let the complication name fool you. It works the same way. And another bullish strategy is selling puts or put spreads. Very bullish on the sell side. Now, on the opposite side, if you thought the market was going down, you could sell a stock first. That's called shorting. Or you could buy puts or buy put spreads to make money if the stock went down. Another strategy is to sell calls that will deplete in value as the market goes down, or call spreads. But if I was you, and you get confused when people start talking about options, put this chart up there by your computer, and when you hear it, plug it in. It makes things so much easier to see until you get where you internalize it. Now, I've got some rules that I've developed for trading debit option spreads, or maybe won't be perfect for you, but it's what I use. If I'm going to do a directional play, and I'm going to use a option spread, I got to buy a call. That's the first thing I try to do. Usually around what they use the term called at the money. That's what I like to do if I'm buying a short-term option spread, at the money for an up market. If I think the market's going down or the stock ticker's going down, I'll buy a put spread in a down market. It's best to keep the very first one that you buy at the money strike or near the at the money strike, and then you sell the option at where you think it's reasonably going to go based on your expiration date. And that reduces your exposure immediately for taking your play in the market. Now, never pay more than half the width. Here's how it works. Let's say we got a $5 width. Well, you don't want to pay higher than $2.50 for any spread. Never do that, over 50%. Never pay over 50%. Use an expiration when you're getting started of 3 to 6 weeks. You can bring it in a lot tighter after you get experience, but 3 to 6 weeks is a good way to start and watch. Now, sell call spreads for down markets. Sell put spreads for up markets. Pretty simple. You're in a bull market, you want to be looking for put spreads. In a bear market, you want to be looking for call spreads. The further out of the money your credit call spread is, now credit, because you're going to get paid money for taking that obligation, you'll get a lower premium, but the higher odds of keeping all the premium. I do this strategy a lot. I call it grinding, okay? Try to use an expiration date when you're on the selling side of 2 weeks or less. Print off that following chart. This chart here will open your eyes to the power of what I just said. You know, it's like flying along, getting towards the expiration date. Look what happens inside of 30 days. The angle of attack changes, the slope of the curve changes, and this is why the closer you get into expiration, people that sell options like to sell options during that phase. If you're buying options, you want to minimize that time loss, and you want to be out 45 to 60 days out if you're buying options. Limits to lemonades. I've done a lot of thinking about this, and you got to know how to do it. If you're long a call, and today I'm long a call, I'm not making money on that call, but I will turn that long call, because I do think it's going higher, it's just not going higher today. I will go sell a higher strike call and make it a call spread, and I can hang in there. Usually my general rule of thumb, if I paid $1 for the first call, I would want to sell that call if the underlying first call got below, say, 80 cents or a 20-cent deficit. That's within the range. If I sell that other call, it doesn't hurt me to do it. Now, if you're long a call spread, we can always sell a higher up call spread to turn the trade in what I call a buzz fly. I've got details about this strategy on my website. This is something I developed because I don't like butterflies, but this one actually puts your odds in your favor. For example, if you're paying $1, you put it into a buzz fly, you can usually get in for 30 cents on the same trade, make better money, and have less risk. Don't you want to learn that strategy? The buzz fly. Now, if you're short a put spread, you can always sell a call spread to turn our trade into a iron condor, okay? If you're short a put spread. And that's where I say kick a field goal, keep it inside of the short that you've sold. And that's just a simple term called iron condor then. Now, when trading options, expiration date and the time you're in a position will determine your success or failure. Most people sometimes make a mistake about picking expiration date. I look out on the economic calendar and try to get beyond and minimize big market moving economic news, because that will kill a strategy on options if you don't take that into account. And here's another rule. I think it's a great rule for all option traders, especially newer ones, okay? Use a general rule, setting a clock, time, 72 hours after you enter the position to determine whether you made a good decision or if you made a bad decision to take action. You don't have to have a number, but you have to have time. Everybody can keep up with time. I always tell people, if you can tell time, I can teach you how to trade. So we're going to do that with options going forward. We put on a trade, we're going to let the clock start running. You got 72 hours. What are you going to do at the end of the 72 hours? You're going to look at that position, see if it's doing what you wanted to do. Now, if it's not doing, you got two choices. Number one, just take your loss and move on. Number two, make a modification to offset the damage that you suffered. And that's what you got to do at the end of 72 hours. Now, DTI members can review our great course that we put together over a 3-month period called Options Made Simple. You can go to our members area, our resource area, and get each individual lesson with proprietary ways to do long calls, proprietary ways to do short calls, proprietary ways to do iron condors, and the buzz fly itself. And how to hedge yourself also. Now, summary. The beautiful thing about options, they give you the leverage and can reduce the risk of outright ownership. Remember, options are a growing market. They've been growing ever since I've been involved. And the key for you is always, always be open to new things in the option market. Educate yourself. If you don't know a term you don't know, ask questions. We told you where to go to get those questions answered. And as I always say, I'll see you on the flip side.